Now we'll be starting with Unit 11. This unit talks all about economic policies. Economic policies are basically the instruments or tools with the government to fix any gaps or attain any goals that the government may have. The two main policies are monetary policy and fiscal policy. So monetary policy refers to actions that central bank takes to pursue objectives such as price stability and maximum employment. Whereas fiscal policy, it is the government's revenue collection and spending decisions. So monetary policy is something that the government works upon via the central bank, and the fiscal policy is basically the treasure or the revenue and the taxation and the spending of the government. Now let's see what is monetary policy. It is a set of tools that a nation's central bank has available to promote sustainable economic growth by controlling the overall supply of money that is available to the nation's banks, its consumers, and businesses. The key objectives of monetary policy are to firstly have neutrality of money, then have the stability of exchange rates, have price stability, achieve full employment in the economy, achieve maximum economic growth, and have an equilibrium in balance of payments. So now let us talk about the instruments of monetary policy. There are two types of instruments, namely quantitative and qualitative. The quantitative ones here, as you can see, are of three types: open market operations, bank rate, and cash reserve ratio. So now what do we mean by open market operations? Open market operations are basically when the central bank is buying or selling securities in the open market. Open market is a place for non-banking institutions to invest with the central bank. Now, what is bank rate? Bank rate is the rate at which the central bank gives loans to all the other banks. So now suppose if the central bank will raise its bank rate or the rate at which it is giving loan to the commercial banks, then commercial banks will be forced to increase their rate of interest when giving out loans to individual consumers. So this will um, make consumers or investors invest less or take less loans. Similarly, it will lead to a shrinking of money supply in the economy. At the same time, if the central bank reduces the bank rate, it will in the same way increase investment. Cash reserve ratio is the ratio of cash which the commercial banks have to keep safe with the central bank. So now suppose if the central bank increases the CRR, then the commercial banks have to keep a greater proportion of their reserve with the central bank, which leaves them with a lesser amount to give out as loans. So this it does in a situation when it wants to reduce investment or money flow in the economy. Suppose the central bank wants to increase the money flow in the economy. In that case, it will reduce the CRR. So now the commercial banks are only liable to keep a little amount or the proportion which is given by the central bank or a smaller amount with the central bank and leaves a greater proportion of their reserves with the commercial bank to give it out as loans. This will increase the investment and the money flow in the economy. Now let's talk about the qualitative controls or the selective control credits. The first one I'm going to talk about is moral suasion. Moral suasion talks about the power of talk. Herein, the central banks conduct speeches, discussions, lectures with a lot of with the commercial banks in trying to persuade them to follow the new monetary policy or the changes in the monetary policy. Credit rationing and margin lending are two again giving out loan policies. Credit rationing is basically wherein the central banks asks the commercial banks to ration their credit or give credit to selective people or selective sections of the society. Say for example, it says or it instructs the commercial banks to give at least 10% of their entire loan funding to women, or say 20% to small and medium enterprises. This way, it restricts or puts a ration on their credit funding. Margin lending. So now what is margin? Margin is the difference between the loan amount given and the amount of security received. Now what is security? Security is the collateral or the mortgage given to the commercial bank by the consumer against the loan that they want. So for example, I want a loan of say 80,000 rupees from a commercial bank. I have to submit some collateral, or I have to give some asset or mortgage something. So for example, I give an asset worth rupees 1 lakh to the bank in return for an 80,000 loan. So in this case, the margin is 20,000. Now this margin requirement or the margin lending is also told by the RBI to the commercial banks, or this from the central bank to the commercial bank. Now suppose the central bank increases this margin lending. That means now the commercial banks have to ask for a greater amount of mortgage or have to hold a greater margin while giving out loans. So now earlier when I had just given 1 lakh worth of my asset as mortgage, now I have to say give 1,20,000, which makes getting loans a more difficult process, which will affect my lending capacity as a consumer. So if the margin requirements are increased, the investment reduces. At the same time, if the central bank reduces the margin requirement, it makes getting loans easier and investment in the economy boosts. There are two types of monetary policies, namely the expansionary monetary policy and the contractionary monetary policy. The expansionary monetary policy is aiming to speed up the economy or increase the economic growth by increasing the money supply in the economy. Contractionary monetary policy is trying to slow down the economy or bring down the economic growth by reducing the money supply. Some major tools of expansionary monetary policy are as follows. The first one is decreasing the interest rate. Now, as you know that when you go to take a loan from the bank, if the interest rate is very high, you are discouraged to take a loan. Whereas if the interest rate is low, it is easier to take a loan, which increases the investment and the money supply in the economy. So a lesser interest rate will lead to greater investment and more money supply in the economy. Similarly, as we just discussed, reducing the reserve requirements. If CRR, which is cash reserve ratio, and SLR, which is statutory liquidity ratio, are low, then there are lesser constraints on the commercial banks to hold their funds, and they have more funds available to give out as loans to the people or customers wanting to invest, thus leading to greater investment and greater money supply. Now, expanding open market operations. As previously discussed, open market operations are when the central bank is dealing in the open market by buying and selling securities. So when it is buying more and more securities, that means it is taking the securities back from the public and giving them the funds, giving them more liquidity and more monetary power. So in the case of a recession, this is the way an expansionary monetary policy works. We have discussed the three types of tools. So let's take them further. So the central bank can either buy securities in the open market or lower the reserve requirement, which is CRR and SLR. It can lower those requirements, or it can lower the discount rate. By all of these measures, the ability of the banking system to create money will increase. Due to this, the money supply increases, the interest rate falls, and the investment increases. Now we know that AD, which is the aggregate demand, is made up of C plus I plus G, which is consumption, investment, and government expenditure. So when the investment part increases of the aggregate demand, the total aggregate demand shifts upwards or increases. When the aggregate demand increases in the economy, subsequently the GDP also increases. So now let's discuss what we just understood with the help of a diagram. Here I have two diagrams. This is diagram 1 and diagram 2. In the previous slide, we just discussed three tools for expansionary monetary policy. If government undertakes, or the central bank on behalf of the government undertakes any of those three steps, or maybe all or combination of those steps, the essential thing to note was that it led to an increase in the money supply in the economy. Now here the LM curve represents what? The money supply or the money market equilibrium. When the money supply in the economy increases, this curve is shifting from this point to from this curve to this. So we are going from LM to LM1. Now what we need to note here is that IS and LM were in equilibrium at point E, which was corresponding to this equilibrium at point E here, which is the equilibrium of demand and supply. Remember, we had also discussed AD previously. So now when government takes any expansionary monetary policy measure, it leads to a shift in the LM curve rightward. Now what this does is it drives up the demand in the economy, because now there is greater production, there is greater income with the people, and therefore they demand more goods, which leads for the demand curve to shift upwards from D curve to D1. And when it shifts upwards, there is an intersection here, and this is drawn down here. So we see that there is an increase in income, there is increase in demand and supply of goods and services in the economy, and therefore subsequently an increase in economic growth. While discussing the expansionary monetary policy, our focus was constantly to increase the money supply in the economy. Why? Because we were in a situation of a recession, or we wanted to boost up the economic growth, we wanted to boost up production. But now imagine we are in a situation of very high inflation and we want to control that. To do so, we will undertake contractionary monetary policy measures. Three examples are taken here. The first one is to increase the interest rate. So now the contractionary monetary policy is just acting in the opposite manner of the expansionary monetary policy. In the contractionary monetary policy, when we increase or when the banks increase the interest rate, it is expensive for the individual consumer now to take loans and invest. Thus, it increases their cost of investment, and less investment is happening, and there is lesser money supply in the economy. Second, when the central bank raises the reserve requirements. Now, when the central bank raises the CRR, which is cash reserve ratio, or SLR, it is creating a higher requirement for the commercial bank to save money with the central bank, or thus leading lesser reserves with the commercial bank to give out as loans. Now, when the central banks or do this, the commercial banks are left with less money to give out as loans. Therefore, the loans become expensive because they are scarce in quantity, and therefore there is less investment and less money supply. Expand open market operations. Here, suppose the central bank starts selling securities. Now, when the central bank is selling securities, people like us who wish to buy those government securities will take up all of our liquid cash or the spare money that we have that we wish to invest and deposit it with the central bank in return for a asset or a security that the central bank gives to us. So what we've done now, or what the central bank has done through this, it has taken up the excess liquid funds in the economy and stored it with itself and given in return a security to non-banking institutions as a security or a bond which we can buy, on which we will end up earning interest. So let's see. Now, if there are increased rates or taxes in the economy, there is contractionary monetary policy. And what does it do? It helps to control the inflation. And when it controls the inflation, the GDP falls and the inflation falls. That means it helps to decrease the inflation and maintain or achieve the goal that we are trying to, and bring the economy out of a situation of very high prices in the economy. The role of the monetary policy is a very important one in a developing economy. We have just seen that the monetary policy can help us overcome a recession and even an extreme inflation situation. So the first point is that the monetary policy can be used to control the inflationary pressures in the economy. By using the contractionary monetary policy, we can reduce the inflation in an economy. Now, when we reduce the inflation, we are actually coming to stabilized prices in the economy. Thus, the second point, that it is used to achieve price stability. If the government or the central bank has a aim to reach a certain price index for the country, even that can be achieved by using either expansionary or contractionary monetary policy. Third, it is used to bridge the BOP deficit. BOP, or balance of payment, is a record of all transactions between a country and the rest of the world. A BOP deficit happens when a country is spending more in the rest of the world than it is able to earn. So, to cover or bridge this deficit, the government needs to increase its production and its income so that it can bridge that deficit. It can be done through an expansionary monetary policy as it helps increase our GDP, output and demand in the economy. Now, the central bank can exercise its current interest rate policy through the monetary policy, as we just saw that it has a lot of instruments like CRR, SLR, bank rate, moral suasion. Through all of these tools, the central bank can exercise its interest rate policy. Now, the monetary policy also plays a very important role in creating banking and financial institutions, in helping their establishment and recognizing them. In the same way, the monetary policy also helps with the debt management of a country. While being a very robust policy, there are some limitations of using monetary policies in less developed countries. The first, large non-monetized sector. In less developed countries, there is a very large non-monetized area which causes a hurdle or a problem in the success of a monetary policy. Most of the people live in rural areas where there is a trend of goods exchange method called the barter system. Since there is no proper banks or money being used, so the monetary policy becomes unsuccessful in influencing that part of the economy. Second, underdeveloped money and capital market. Money and capital markets are underdeveloped in less developed countries. Because there is a lack of bills, stocks and shares which limit the success of monetary policy. Third, there are a large number of non-banking financial institutions. In less developed countries, or we can say in developing countries also, there are a lot of local bankers which give out credit and they work on a large scale. But because they do not come under the control of a monetary officer or are not directly under the control of the central bank, thus the effectiveness of monetary policy is limited. Fourth, high liquidity. With commercial banks, they are not affected by the credit policy of central bank. It also makes the monetary policy less effective. Fifth, foreign bank. Almost in all developing countries, foreign commercial banks do exist. They are there by selling foreign assets and by taking out money from their main office, make the monetary policy less effective because they are governed by the central bank of their economy. Sixth, less bank money. In less developed countries, monetary policy is less effective because money is in a small ratio in the bank and the rest of the money is not in with the commercial banks. So central bank becomes incapable of controlling the credit in a very effective manner. Seventh, money is not deposited with the bank. Prosperous people do not deposit money with banks. Instead, they store them in different other assets like real estate, jewelry, speculative consumption. And because of this creates inflationary pressures. And because these activities do not come under the central bank's control or under the monetary policy, therefore the policy becomes a little bit ineffective. Now let's discuss the other economic policy, fiscal policy. The word fisc means state treasury, and fiscal policy refers to the policy concerning the use of state treasury or the government finances to achieve the macroeconomic goals. The policy under which specific economic objectives are achieved by the government by making changes in government revenue and government expenditure is known as a fiscal policy. The objectives of fiscal policy are quite similar, or you can say the same as of the monetary policy, because both the policies or the both economic policies aim at achieving the same goals. Now it is the current economic situation which leads us to decide which policy we will be using and whether we will be using the expansionary or contractionary type of policy in both the cases. So once again, let's go through the objectives of fiscal policy: to achieve full employment in the economy, or you can say to reduce whatever the current rate of unemployment there is. Second, to achieve price stability, or again we can say to reduce inflation or deflation. Third, to accelerate economic growth or to achieve economic growth targets. Fourth, equitable distribution in the economy. Fifth, external stability. Now, external stability is nothing but the BOP equilibrium, balance of payment equilibrium. There are two equilibriums in the economy: internal equilibrium and the external equilibrium. Internal equilibrium is achieved when we equate aggregate demand with aggregate supply, that is within the economy. External equilibrium is when the economy is in equilibrium with the rest of the world as well, that is the external stability. Sixth is capital formation, or it is the basis of all development that is going to happen. And seventh is regional balance, again nothing but balance in different regions. So that those are the objectives of fiscal policy. If you get confused, you can keep the objectives of same for both the policies, or if generally asked what are the objectives of any of the two economic policies, it can be a coherent answer. Now, let's talk about the tools of fiscal policy. We just, let me say that word once again. It is the policy regarding the treasure or the finances of the government, right? So this plays in two ways. Now, the finances of the government, again, it's two things come under finance: the revenue and the expenditure, what I'm earning and what I'm spending. Now, under revenue, as if you have studied the budget, you would know that there are revenue receipts and capital receipts. Revenue receipts are nothing but tax and non-tax receipts that the government is getting. What is the main revenue that the government gets? It is mainly the tax which the taxpayers pay either directly or indirectly. And what are the expenditures that the government is making? Either they can be classified again into revenue and capital expenditures, but government is basically making expenditures on all kind of public provisions for the people. So again, there are two types of tools: revenue tools and expenditure tools. The major revenue is the tax, and the major expenditure is on public goods and services. Similarly, like in the monetary policy, here also we have two types of fiscal policies, which is expansionary and contractionary. In the expansionary policy, we are trying to expand we can say the circular flow of income, or we are trying to expand the economy as a whole. So to expand that, we will reduce the taxes or we can increase the government spending. They can be taken up together or individually. Similarly, when we are talking about contractionary fiscal policy, we are talking about reducing the government spending or increasing the taxes. By both these things, we are leaving lesser money in the hands of people. So let's talk about the expansionary fiscal policy. If the GDP of the economy is below the full employment, then there is a recessionary gap that exists, or there is some unemployment, because we are saying that it is below the full employment level. So there is some gap or some unemployment is existing in the economy. So expansionary fiscal policy is trying to do what? It is trying to overcome that gap. How it will overcome that gap? If it will increase the aggregate demand. Now, to increase the aggregate demand, again, let's recapitulate. Aggregate demand is C plus I plus G, which is consumption plus investment plus government expenditure plus NX, which is the net exports, which is the external sector. All right. So coming back, if the equilibrium of the economy is below the full employment level and there is some gap that exists or there is some unemployment that exists, we will undertake the expansionary fiscal policy which will aim to increase the aggregate demand. Now, how it will happen? Increasing government spending and decreasing the taxes. Now, if government will increase the spending, that means the G component of AD will increase. So C plus I plus G, the G component of AD will increase, the aggregate demand of the economy will go up and it will help in reducing that recessionary gap. Now let's take up what we just discussed in the format of a diagram. Let's assume that this is my consumption curve, consumption and investment curve. When government expenditure is added to it, we get this curve, C plus I plus G. This is my aggregate supply curve, which is the 45-degree line, and I have my aggregate demand curve, which is C plus I plus G. The equilibrium here is at point E. Now suppose that there is a change in government spending, or the government has increased its expenditure by this delta G amount. So the AD curve shifts upwards to C plus I plus G dash. This G dash is indicating the new government expenditure level, which is this G added by this G, delta G. So now you see that the intersection between aggregate supply and aggregate demand has moved to E1 and the income in the economy has increased. So let's take a look again at the expansionary policy. There is some, so the government increases its investment. There is economic growth, as you can see that the income increased, and this leads to decrease in unemployment. Just I'll take a minute to explain how. When the income in the economy increased, or just simply let's say that the aggregate demand is increased in the economy. Now, when there is an increase in demand in the economy, there is a requirement for increased production. When there is a requirement for increased production, more and more resources will be involved in the production process. More people will be hired to do that production, to answer to that increased demand or to increase that supply. So thus the unemployment will reduce. In this way, the expansionary policy works to increase or to decrease the unemployment. Just like expansionary and contractionary monetary policies, there are expansionary and contractionary fiscal policies. We have just discussed the expansionary fiscal policy, wherein the government is increasing its expenditure, leading to output growth and GDP growth, etc. In this case, the expansionary fiscal policy is discussed again. I'm going to discuss this once again so that I can make a direct comparison between the contractionary case. You remember we talked about the equilibrium being below the full employment level. So let us assume that this is the long run aggregate supply curve of the economy, which is at the full employment level. What I'm trying to say is that if this is the aggregate supply of the economy, then all the available resources in the economy have been employed. That means all the people who are willing and able to work have been employed. So this is my long run aggregate supply. But the current situation is that I am in a situation over here, and this is my aggregate supply, the short run aggregate supply, and the aggregate demand is right here. At this point, we are at equilibrium. Now, if the government increases its expenditure, the AD curve shifts upward and it can intersect with the short run aggregate supply at this point, where they are also coherently intersecting with the long run aggregate supply curve. So this is the situation where we land up at the full employment level using the expansionary fiscal policy. But suppose I am in a situation where where my equilibrium is beyond the long run aggregate supply curve. All right. If I'm here, then what do? I need to reduce my aggregate demand and bring it back to long run aggregate supply. In this case, what the government can do? Either the government could reduce its expenditure or increase the amount of taxes it is currently implying on people, and which will lead to reduction in aggregate demand and bring the economy back to the long run equilibrium where we have attained the full employment. Now let us discuss the pros and cons of an expansionary fiscal policy. As we have just seen, that when we use an expansionary fiscal policy, it helps to reduce the unemployment level in the economy. But at the same time, it can lead to inflation. Contractionary fiscal policy definitely helps down bring the inflation, but it can also increase unemployment. So it is at that time we have to see that whether the economy, what is the main goal of the economy at that particular time, whether we need to tackle the unemployment or the inflation, which is our main target, and thus we will choose our policy. Thank you.